Hello and welcome to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. The show is presented to you by Gaslowitz Frankel, a law firm dedicated to resolving disputes with your wealth, whether through your will, your trust, your business, or your investments. For news, pictures, and tips, go to our website at gaslowitzfrankel.com or follow us on Twitter at Estate Dispute. Our show's hashtag is Wealth Matters. I'm your host, Adam Gaslowitz, and I'm here with my partner, Robert Port. And today we're talking about sophisticated uses of credit, because credit is not a four-letter word.
And now it's time to introduce our guests. We are pleased to have with us today Allan Hamer, Senior Vice President, Private Client Manager with Bank of America Private Bank, and Itai Tsur, Senior Vice President, Private Client Advisor with Bank of America Private Bank. So Allan and Itai, let's get started by having each of you give our listeners a brief overview of your background and your particular expertise. Let's start with you first, Allan.
Thank you. Again, my name's Allan Hamer. I've been with Bank of America 24 years in banking right out of college. I'll say 30 plus.
That's close enough.
A long time. On everything from retail, managing the branches, to being a manager in what we called our middle mass affluent market. Did that probably for about 10, 15 years. And then the last 10 or so have been in the private bank, where one time we're a U.S. Trust. We've rebranded to Bank of America Private Bank. But for the most part, I sort of holistically take care of the client, the families that we have here that are more on the wealthy side, I'd say.
And is that, both of you are with Bank of America Private Bank. Does the private bank connote folks with greater means and net worth?
Yeah, we try to pick out the folks that usually probably have a net worth of about $3+ million. For the most part, they need special handling, or they want us to look at them from a little different perspective. So.
Okay. And Itai, tell us a little bit about your background and your expertise.
Sure. Good morning. Thanks for having me. So my background is initially as an attorney, so I don't practice anymore, but I parlayed that into into working in the nonprofit space, and then I ended up in what's called plan giving and endowment. In fact, I was many years ago on this show in a different capacity when I was running the Jewish Foundation here in Atlanta. And so my expertise is in sort of the strategic and structural uses of charitable giving for tax and other purposes, ultimately, of course, with the aim of fulfilling the donor's desire to kind of give to the causes that are important to them and their families. And then I've since moved over to the private bank, so Allan and I are on a team together, so I not only apply my background in charitable giving, but I work understanding sort of the broader needs and really the complexities of the individuals who we work with, or we're trying to work with, and that's why we're here today talking about credit.
Okay, so the topic of the show is sophisticated uses of credit. And as Adam indicated, some people might think credit is a four-letter word. Can you tell our listeners why that is not the case?
Well, or even tell them what credit is.
So
what is credit?
It's 5 letters, so that's kind of that's the way I would explain it.
I think it's
to my
6
kids.
letters, actually.
CREID. It's in 6, in fact.
All right, there you go.
Missing a finger. I think the issue is that people automatically associate credit with, I need something I don't have currently the assets for it, or the money for it. I have to take out a loan, right? So I have a mortgage in my mind. Okay, the bank still has a certain percentage of my house that it owns. That isn't for many of us who aspire to not have those worries and to be able to sort of have this kind of self-realization that we can do what we want to do. That's sort of a ways down, right? And so I think
also credit implies debt.
That's exactly right, right?
And so you have to pay it back.
Yeah, and it implies that you are beholden to someone, right? That is, I think for many people, that's kind of the specter that sort of is floating out there when you're trying to talk to them about it. But what we're seeing increasingly with our clientele, and when we talk to advisors such as yourselves and others, is that credit really is just one other facet of an individual's wealth strategy. No different than having an equity portfolio, having fixed income. There is a space for credit, especially in an environment such as this where interest rates are at historic lows. And there's what we call an arbitrage, an ability to take advantage of the ability, if you have $100,000, right, and you could put it in the market and gain 5%, right? Or you could take out a loan where it's going to cost you 2.5%, there's money to be made in the margin. So it's not, it unlocks opportunities. And I think that is sort of where we're seeing increasingly people taking advantage sort of this credit environment, understanding that, it's not necessarily debt. In many cases, they can just pay off, the whatever they've borrowed in the event that they need to. It really is just leveraging your money towards its best use.
So we're not just talking about borrowing money for the sake of having cheap money. We're talking about specific uses, people who have specific uses, specific needs, and they could use their own assets or they could borrow money.
Right. So a lot of our clients, we talked about this, they want to have a portfolio that's diverse. Like Itai said, they may have equities, they may have bonds. They also want to have real estate. They want to have what we call investor real estate. They may want to buy a warehouse. They may want to buy a hotel. Whatever it is, if they can diversify out of the equity market and get a hedge, how do they purchase those real estates? We mentioned earlier that rates are historically cheap. If you can do a loan at 3.5%, in something like a hotel or a industrial park or even a multifamily that's giving back a capital return of 6-7%, you're ahead, and it diversifies the individual so that he's not all in equities. He now has a portfolio that's not reliant completely on the market.
So instead of liquidating his equities and using those proceeds to buy real estate, he would borrow money, against the portfolio?
He could do that. That's one source. That's probably the cheapest source of borrowing money is what we call a margin loan. And the rates today, with LIBOR we use the 1-month LIBOR rate, and that rate is about 2.1%. So on a typical, if we lend against a multifamily property, we'll probably spread the rate between the LIBOR and our actually what we call cost of funds for the bank, say 2 to 3% over that LIBOR. So if we do a spread of 2, we're at 4% for someone to buy a multifamily property.
And just for purposes of our listeners, tell everybody what LIBOR is.
Okay, so LIBOR is I don't know the acronym of it, the International LIBOR, International London Exchange Rate.
London International Interbank.
Yeah, it's like the prime rate. Okay. And there's different rates that are used for folks that have equity lines that they call HELOCs. It's prime rates that's used. They spread it over prime. On the more sophisticated credits, such as the ones that we offer, we base it on LIBOR. It's just another index that's used.
So you used a couple of words, both of you, when you were explaining this approach. You used a couple of words that may not be familiar to everyone. One was arbitrage,
right,
and the other was hedge. So can each of you or one of you just quickly give our listeners a definition of what each of those means? Because you've actually given examples of that as you've described it, but I want to be sure our listeners understand.
Yeah. Let me talk about arbitrage for a moment, because we've had a number of clients over the years, especially since 2008, when the Fed basically dropped interest rates to near zero. So you had a situation where LIBOR was 0.25, and we had a client or two that had taxes due. Okay? Whether it was from deferred comp or whatever, had to pay estimated taxes fourth quarter. We had a client that owed about $1.5 million in taxes. He had it in the bank. He could have paid it off. He was approached by our team, and we sat down with him and explained that you could pay it off, that $1.5 million, or you could, in a sense, borrow. He had another portfolio that was not touched. You could take that portfolio, he had about $5 million at the time, and borrow against it at LIBOR plus 1.25. He was all in 1.5%. Now, we never guarantee what the portfolio is going to return. We can't do that. We're a fiduciary. That's not the way we work. Some years, as you know, the market's up. Some years, like in 2008, it goes down.
But a lot of times the client knows that they can do more with the money than...
Right, yes. So in this particular case, he wasn't aware that he could borrow against his portfolio to pay taxes. So we offered this strategy, saying that we don't know how long rates are going to be near zero, but why not take advantage of this, given that if the market can return 5-6% or more, you're ahead. And it turned out over the last 11 years, I mean, he's probably made an average of 10 to 15% on his portfolio, while paying cost of funds probably 2 to 3.
Right, and another benefit of that would be if he had to liquidate any of his portfolio. While we don't give tax advice, there's a possibility of some capital gains consequences if he were to liquidate part of his portfolio to pay a tax bill.
Yeah, that's a big factor for a lot of clients, especially if they're buying other assets, so they can leverage their portfolio versus cashing in that is a big consideration.
So it's almost like you're comparing the cost of the loan to the opportunity cost of what they could do with the money.
That's exactly
Yeah,
right.
yeah.
And then Adam, you had sort of just earlier had asked about getting cheap money for the sake of cheap money. There are people who are doing that. That's sort of, there's this concept of dry powder. Right? It's this idea that we don't know what's going to happen to the market. The cost of keeping a couple million, couple $100,000, whatever it is on the side, is again at historic lows. Maybe I can leverage whatever the asset is. If it's my portfolio, we'll talk about other assets that people can use here in a minute. But maybe I'm going to keep some of this cash on hand to take advantage of a downturn, right? Because there's an old saying that goes back to the Great Depression: fortunes are made and lost, in these sort of financial crises. And for those who have the cash on hand, you can buy sort of at the basement and then just let it kind of float up again.
And
That's another phrase that's often used in the financial world that lay people may not understand, which is keeping dry powder,
Right.
which is having either the liquidity or quick access to liquidity. Is that essentially?
Yeah, I mean,
the
basically, right.
concept?
It comes from naval warfare and the idea that you needed to protect your gunpowder in order to quickly employ it in the event of conflict, right? So in this case, we're talking about your assets, your cash, and if you want to take advantage of an opportunity. And really, for a lot of our clients, for a lot of the people who could be our clients or who are generally sort of that in that tier and have that flexibility with what they can do with their assets, taking advantage of opportunities on a relatively sort of short basis because they're very sophisticated, their advisors are sort of encouraging them to take advantage of certain strategies. The timing is critical for many of these individuals, and having that cash on hand really can be the difference.
I assume your clients are the ones who know what they can and can't do with their own money. You don't need to tell them. They know that they need to do something, and they need other resources to be able to do something else with those.
Right, that's a good point. Most of our clients are either C-suite executives or they're business owners. We do have some trust babies, as we call them, but for the most part, the folks that are using credit are sophisticated. However, if we can provide them a means of getting cheap money and enable them to buy what they want, or as we mentioned earlier, diversifying their portfolio as a hedge, folks are always looking to say, what can I do to do something different to offset all the equities or bonds that I have?
Yes, there's also a lot of concern people have about paying taxes. And
Right.
I imagine that if you're going to either borrow money or use your portfolio, you've got to liquidate something, which generally means paying capital gains
Right.
tax on the gain. Whereas if you're leaving the portfolio intact and borrowing money, you may pay interest on it, but portfolio is doing better, you're not paying the tax, and you can still do the other thing that you need to do.
Plus, I mean, yes, you're absolutely right, and that was one of the other factors is, these more complex portfolios, if you simply pull out a piece, it actually, there is a stasis, right, that exists with the way that they have been designed by professional investors who kind of look holistically at the individuals or the families, entities' investments. And so simply saying, okay, I'm just now going to sell $100,000 for my large cap equity position means you have to reset everything else. So it's not simply just, it's like a Jenga puzzle.
You got to
People
rebalance
gotta-
it. You got to
that's-
rebalance
You have to
the portfolio.
rebalance it, right?
Yeah,
And then there's effort there too. And it may or may not be operating at the same level as it had been prior to that disruption.
So let's talk about some of the specific instances where you've seen people, your clients, use this facility, if you will. And it strikes me as what's happening is people are being their own bankers.
That's right.
Is that fair?
That's exactly, that's a perfect way to encapsulate it.
So tell us some examples of how this is used in your experience.
I've had a number of instances. Probably the recent one is a client using his portfolio to build a storage center. He had a couple choices. You could do a construction loan, which are difficult to do. You can do them. Not a lot. There are banks that do it. Some of the smaller ones.
Finance your own construction,
Finance
then,
your own
then
construction,
get a permanent
right,
loan when you're
make a
done.
permanent loan when you're done, when it's stabilized. A lot of the banks are a little hesitant when projects aren't stabilized, and stabilized meaning that they have current income coming in and to pay the bills. So he used his portfolio. He had probably about $4 or $5 million, and we were able to lend, say, 70% of his portfolio. So again, he avoids capital gains, cashing it in, because he's going to make a lot more money on that storage center once it's up and stabilized, or if he sells it to a REIT. So his strategy was to build these storage centers, sell them, build, sell, and he did terrifically over the last several years. But his first couple storage centers were built on his margin account.
And what's the term of a credit facility like that?
So if he's doing something like that, to the construction portion is normally interest only, so that could last a year to year and a half if it takes that long to build. Once it's stabilized, or even after a year and a half to 2 years, it converts to, say, a 5 or 7 year note. We normally amortize it over 20 or 25 years. So we can have normally it's a floating rate, again, on LIBOR. Today's environment, we've changed a lot what we do in terms of what we call swaps and things, and more sophisticated ways of fixing the rate. We can actually quote fixed rates on these now. For folks years ago, it was more difficult to give a fixed rate. It was usually floating unless they wanted to do a swap. Swaps have become very convoluted for individuals. So we've now are offering fixed rate terms, 5, 7, 10, and there's some banks out there doing a 10, 15-year fix.
And you're doing it on these kind of loans?
Yeah.
Fixed
yeah,
rate?
Yeah.
Even though LIBOR may fluctuate?
Even though LIBOR may fluctuate, we'll lock him in, say if he wants 5-year money, we'll give him a quote. However, there are penalties to get out of that. So if you pay that off early, you're stuck paying us a pretty hefty penalty, whereas a LIBOR floating loan, they're normally simple interest, meaning you can pay it off anytime you like.
And how often, I mean, LIBOR, I think there's a new rate every day. Am I right?
No, it changes when the Fed changes. So if we recall, a few weeks ago, the Fed went down a quarter.
Right.
And that immediately changed LIBOR, it's the shortest term rate we have out there. That and prime adjusted accordingly downward.
Okay, so it's
LIBOR won't adjust unless
the Fed decreases or increases interest rates.
Okay, so it can be fairly stable.
Yeah, it has been. You can obviously look and see what the history has been, but it is still cheap.
Okay. Do people use it for personal things like building a vacation house or buying a vacation house?
Sure.
Absolutely.
Yeah.
Buying yachts, buying airplanes. Actually, so one of the other success stories, this we can't claim credit to us, but this was one of our colleagues in Miami. There was an individual who had, and so this is kind of something I alluded to earlier. It's not just sort of your traditional equities and other assets that people are using for leveraging credit, but in this case, there was an individual who had a valuable art collection. So art, fine art, paintings and such, is increasingly an area because it's in, the masterpieces especially are in sort of dwindling supply. There are no more Rembrandts because of
Although there's one more Da Vinci. Right?
There's some. My kid's a very good artist, but no, there is these as an alternative asset for investment purposes. You were increasingly seeing a lot of money going into this area, and so we had a wealthy individual who wanted to build hotels. And getting hotel loans is very difficult post-08 for a number of reasons, which Allan can kind of delve into if you're curious. But what the individual did instead was essentially put up their art collection and borrow against it. They didn't even have to take it off their walls. It didn't have to go in a storage facility. It didn't have to go under armed guard. It really was just a team. The bank happens to have an expertise in this specific area, especially. Team went down, assessed what this individual had. There's a diversification, all kinds of considerations in the art world that they make in order to figure out how much capital this can unlock. And at the end of the day, the individual, the borrower, was able to build hotels just based on the art collection.
And still enjoy his art.
And still enjoy his art. It never has to come off the walls.
And not have to worry about going through the construction process. That can be quite arduous as far as getting it approved, going through the steps, and the expense of doing that.
You're listening to Wealth Matters, the radio show where we discuss the opportunities and challenges of preserving and managing wealth. We are your hosts, Adam Gaslowitz and Robert Port, from the fiduciary litigation firm of Gaslowitz Frankel. We are talking today with Allan Hamer, Senior Vice President, Private Client Manager with Bank of America Private Bank, and Itai Tsur, Senior Vice President, Private Client Advisor with Bank of America Private Bank. And our topic today is sophisticated uses of credit.
Right. So it sounds like a client of yours doesn't necessarily have to have a brokerage account with the bank, but there are other things that you will make these kinds of loans on.
Sure.
So besides a brokerage account and art, what other things do people use to secure or collateralize these loans?
Well, again, there's a number of things they can use. Talking about using their portfolios to do something, or are they talking about other assets?
You'd mentioned hedge funds, I think, when we were talking a while back. I guess that's part of a portfolio, an illiquid part of a portfolio.
Yeah, well, sometimes these are a little more sophisticated means. If folks are in a part of a hedge fund and their liquidity's tied up, there are times that we can go and possibly use the portions they have in their hedge funds to to possibly unlock. It's a little more complicated on that, or private equity that some folks are investing in. Or we may lend to a hedge fund who are looking to do capital calls. That's probably more typical of what we would do if we're looking at a hedge fund.
Do you lend to estates or trusts that may be illiquid at the moment?
We do, if they have a tax problem. And again, it's usually based on their portfolio. So if they're
Usually it's a liquidity problem.
You have to have some collateral of sort. And normally the banks love the liquidity, the ability to know that if something happens, we have access to
Right.
funds.
So Itai talked about lending against artwork, which is not immediately liquid, but presumably masterpieces have a ready market. How about other collectibles? Cars, coins, jewelry,
We've been asked
guns.
that. Yeah, those are great questions, and we haven't gotten there yet. We've been asked by a number of clients if we would consider it, and I think there's an individual here that could probably talk to that as far as maybe in the future. Cars or fine jewelry may be an option for us, but right now it still isn't. I don't know if there are other banks that are doing that or other institutions.
Yeah. I would think in the future, if you had sort of, I think, Adam, you went to a car show recently, a fancy car show on the West
Yes,
Coast.
the Concours d'Elegance.
That's right.
Pebble Beach.
There are cars in the 9 figures, right? So, so my guess is if a borrower had that, certainly there would be an effort to see what could be done about borrowing against it.
Though I can say that if someone has these collectibles, they have a pretty strong balance sheet. It is possible we can do what we call an unsecured loan, knowing that they have these collectibles. They have things that can be liquidated, though it may take some time. So not a lot of banks do unsecured loans, but that is one source of what we do for the right client.
Again, based on these same LIBOR type rates?
It can be based on LIBOR, yes.
All right. What are these loans not good for?
I would say I would never recommend someone to borrow money to then, again, put in the market. That's the true purpose of risk. You're borrowing your own portfolio to buy additional, equities or investments. But I think a good use of credit is buying a good asset, a hard asset, whether you're doing a mortgage on a house. Some folks like to say, I'd rather pay cash for my house because I'd rather sleep at night. That's a whole other topic we could talk about. However, with a mortgage rate right now at 2.8%, why would you want to pay cash for a house if you're buying a house? Now, you may have the means to do so, and you can take that money and do what you like with it. But if the rates are so cheap, why not use that for a hard asset? As long as it's for a good purpose, I would never say borrow money to go on vacation. Or even in my younger years, I saw folks borrowing money to buy diamond rings for their fiancés and things of that nature.
Oh, it's a terrible idea.
I'm sure some of your clients will be regretting that.
Right, especially divorce. Marital strife.
All right. What about other kinds of uses of funds that you would not really recommend they borrow this kind of money for? A pot farm or
so there are a lot of every bank's different, and there are considerations in terms of there may be things, for instance, like for-profit jails, right? They're legal. Some banks might just not want to be in that business. So if someone wanted to borrow, let's say they had an amazing portfolio, that great, personal financial statement. It's usually sort of what we initially look at to assess these, where we can go with these loans. But they want to borrow it for a cannabis farm, right? There are legal issues, which you guys can opine on far better than I, but they're complex.
That's not what we do.
I understand.
We do estate and trust litigation. We don't.
But
we
in
don't
terms
do any
of,
platform.
it's sort of a gray area in terms of, what you can even do with these. And so I think there is an example of some of these kind of more controversial from a holistic standpoint, more controversial uses of the assets. And so. I would not recommend it for that. And
how about something like vacant land?
Yeah.
Is that something that may have some value? I can imagine it would have some liquidity issues if.
Well, and there's environmental issues. I mean, there are all kinds of issues when you're buying real estate.
But we do have those available, vacant land. Normally, we will do a loan on vacant land if the client or applicant is going to build on it eventually. It doesn't have to be right away, but we will lend, say, 50% of the value of the land. And again, as long as they plan on doing something. We're not in it to just lend on vacant land for spec purposes, but we will look at that.
Okay. And since you mentioned it before, What's the difference between a margin loan and these kinds of alternative loans, these special purpose loans that we're talking about now?
So a margin loan, if you're borrowing against your portfolio, you can use that money for just about anything unless it's something that creates reputational risk for the bank or we feel it's not appropriate, we will not lend. There are times that when someone says they want to borrow money on their home to fund the business, we're even careful about that. They're personal residents and they want to use those proceeds to inject into their business. We're very careful on how we do that. But for the most part, they can take the money from their portfolio and do anything that's legal. As far as if they want to help the education, if they want to use it for a boat, for any hard asset, because that's really the cheapest use of getting money in terms of borrowing today.
But the margin rates, to my understanding, are generally your traditional margin rate is much higher
Yes.
than what you're speaking about here. So why is that why the distinction there? Is that because the customer, the holder of the securities that they're margining, sort of has their own control over it?
Yeah, there's different what they call margin rates. So if you're at a typical brokerage customer, say at another firm, you can, when you open up an account, say you're self-directed, you're doing your own thing, you have your investments, you can, upon opening that account, have margin, which means you have $2 million in the account, they'll let you borrow $1 million. No questions asked. However, that's a broker call rate, margin rate. That's usually about 5-6%. It's based on a different index. I'm not as familiar with that, but I know it's not as cheap as if you're dealing with the private bank here. So we have folks who have a pretty substantial balance sheet. We're helping families preserve their wealth, pass it on to the next generation, so on and so forth. So our rates are based differently. We also give the folks a little more time. If there's a margin call, like recent happenings for a couple of my clients, we give them several days to cure or to take care of the margin call. If you're in a brokerage account, your rate is higher. There's no control. If you don't cover it that day, they sell you out. They will sell your securities to make sure they cover. In our case, because we know our clients, our rates are lower, and we're able to give them some time to cure the call.
Right, and what many customers don't understand, clients don't understand in the margin situation is when there's a margin call, as you said,
Right.
the bank brokerage firm has the discretion as to what to sell. So
Right.
That's right.
you may want them to sell loseallmymoney.com rather than your Home
Right.
Depot or your Coca-Cola stock,
Right.
but the
Yeah.
bank has the discretion as to what they're going to sell.
Right, and we have the time.
So what do you tell your clients to consider when they're thinking about these kinds of loans? I mean, are there issues that they need to be aware of? Are there things they need to go over?
Yeah, I think we just don't want to put our clients in a situation where it's not comfortable for them to pay it back. Even though someone may be qualified for a loan, you can afford to buy a home. Today's rates, the rates are cheap. You can get $1 million home, and can you? There's one thing to get approved by a bank, and another equation is, can you really afford that house because of your lifestyle? So there are considerations beside getting approved, at least on the residential consumer side. When we're talking to our clients, if they're looking to buy a multifamily or an industrial park or a strip center or a hotel, these are sophisticated clients. They know what their return of capital needs to be. I don't need to advise them, is this a prudent ask for you? We'll decide if we can qualify them and if it makes sense from a cash flow and liquidity standpoint. But for the most part, those clients are sophisticated enough if they should do it.
And then there's just an aspect of sort of preparing them for the process, right? I mean, post 08, it's all there's a lot more.
Maybe can you walk us through? And I understand these are a lot of one-off deals, so there's no one way to go about this. But walk us through generically how you would proceed to qualify someone for a loan like this.
Right. So we would want to better understand what they want the loan for. We'd want what we call a personal financial statement, which sort of gives us, from their perspective, an initial picture of sort of what their wealth is, what their liquidity is, where their money currently is. There's an underwriting process, and that takes some time. And I think I refinanced my house a couple of years ago. It is thorough. We'll put it.
That's a gentle way of putting it. Yeah.
There's a saying amongst real estate attorneys that the most complicated transaction there is a house refinancing or the purchase of a residential home.
Yeah, my boss may be listening, so I have to be careful what I say about mortgages. However, with the Dodd-Frank Act, you may know that it has become more difficult to do a mortgage. We are trying to simplify the process, but even if you have $10 million in the bank, or you have 500,000 in the bank, the process is the same in that we have to collect tax returns, we have to collect business tax returns if you're a business owner, W-2, K-1s, figure out if they have other, debt, what that is, how they're paying it back. They have alimony. It gets very complicated on what we have to produce to so-called, I hate to say this, paper the file to make sure we're in conformance with, regs out there.
All right. As we wrap up our show, I want to give each of you an opportunity to give us an example of a success story that you've had, or one that was not so successful that could have been done differently. Allan, do you want to start? Or?
Sure.
All right.
Recently had a client that was referred by another client, and he needed to buy a hanger for his jet. It's a tough problem, right?
I hate when that happens.
That's terrible. So he had.
Can't wait to hear the success.
This was an
story.
easy one. It comes to my mind easily because it was a great deal for us and for him. He had a pretty large bond portfolio. When we, because of the size of the portfolio, we were literally able to price the loan at LIBOR plus 70 basis points, or 0.7, which is very, very cheap money. So instead of him going through the process of getting a hanger loan, he didn't want to use his cash. He didn't want to cash in the bonds because of tax implications. And his advisor said that with money being so cheap, borrow it. So we brought the bonds over, put a margin loan in place, and instead of going through the process of doing a hanger loan, which takes more time and effort.
A hanger loan.
A hanger loan. Yeah, basically.
That's a thing.
That's a thing. You buy a
You guys
like a
don't have
closet
your
for
private
your.
jet
Yeah, don't you have a jet?
We're
Just keep
making
it at the
notes.
public airport like everyone.
I pay cash. I didn't need a hanger loan.
This particular gentleman also owns his own island, so he probably could have parked it there. But for the States, he needed somewhere to park his jet, and we were able to do that in probably 2 or 3 weeks, which was easy for us, and it was cheap money for him. He didn't have to cash bonds. He could have liquidated easily. He had enough to do it. But
Right, and that's a great illustration of what we were talking about before, which is sort of being your own bank.
Right, he was.
And then one of the strategies that we're trying to employ to get more individuals to kind of embrace credit is to work with other advisors, registered advisors who don't necessarily deal with credit and are mostly there for the sort of the wealth advising and for the investments. And we were working with one, and they presented us with a mortgage. It was actually going to be a pretty substantial mortgage in Florida. Unfortunately, as we dug deeper in that kind of initial phases, the ownership structure of the assets that would be guaranteeing the mortgage became extraordinarily complicated. And Allan, with his experience, was sort of very early on said, okay, we need probably to get a real estate attorney to kind of unlock some of this. So it's still an ongoing discussion, but we thrive in kind of these complex situations. But it was a very, very convoluted isn't the term I want to use, but it was a very, very complex structure. And so we're
you
still
guys were
unpacking
able to
it.
easily deal with.
Yeah, extremely. just like it's like the just pulling the
Just
thread
so-
on the
just
Gordian
so-
knot.
just
yeah.
so-
But we do have the ability to do more complex loans in our group because of the client, the
That's right.
nature of the clients that we have. So it's not always in the box. So it is.
Right, and I think that's one of the things that's interesting about this, which is, since it's atraditional, it can be customized, and you can focus exactly on what the client needs and their own assets to structure something that's appropriate for them, as opposed to going to X, Y, and Z and your traditional construction loan or your traditional mortgage.
right.
Where
Traditional
it's-
hanger loan.
Yeah, right. So that's what we, hopefully we're doing a good job as a team if we look at them holistically and say, listen, you could do what you want to do, or we have other alternatives for you that might be a better process and less expensive.
All right. Why don't I get each of you to tell our listeners how they can reach you?
Well, I can be reached at Allan.Hamer, that's ALLAN.HAMER at bofa.com is probably the best way to reach me.
All right. Itai?
I can be reached at Itai Tsur at bofa.com, and
You're gonna
that's
have-
obviously phonetic.
Easy to spell, yeah.
It's John Smith in Israel. It's itai. T as in Tom, S as in Sarah, U, R as in Robert at bofa.com.
All right. Okay. As we're wrapping up our show, I want to thank everyone for listening to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. For more information about Gaslowitz Frankel, please go to our website at gaslowitzfrankel.com, and remember to follow us on Twitter at Estate Dispute and use our show's hashtag Wealth Matters. Our guests today were Allan Hamer, Senior Vice President and Private Client Manager with Bank of America, and Itai Tsur, Senior Vice President, Private Client Advisor with Bank of America. Please join us every fourth Wednesday of the month at 8:30 a.m. here at Wealth Matters on Business Radio X.